Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, I'm going to walk through my portfolio. A lot of folks have emailed me here in December and said, hey, can you give us an update on your portfolio? I will do that. I can tell you, if you go back to, I think the last time I did this was a year ago, not much has changed. And I actually think that's a good thing. We're going to talk about it. So I'm going to walk through my portfolio, stock, bond allocation. I'll talk about the specific funds and stocks that I own. By the way, I don't do this because I think this is how you should invest, but I do think you're kind enough to listen and support this channel. I talk a lot about investing in my approach. You ought to, see that I'm sort of eating my own cooking, as they say. I invest the way I talk on this channel, and you'll see that in a minute. But the other thing I'm going to do is I'm going to throw out there 5 challenges for you to consider accepting for 2024. These are investing-related challenges. I've decided to apply these to my own investments in 2024. I think I actually met them all in 2023, but these are 5 investing challenges that I think are important, at least to me, in managing our investments. And actually, I'll start with the first challenge as we get into this, and it's to use some kind of tool to track your investments. You want to know what investments you own, what the asset allocation is for your overall portfolio, not just in a given account. You want to know your expense ratio. There are plenty of free tools. This came up as I was preparing for this video. I use and have tested many. I was looking at Full View, which is something offered by Fidelity. It's free, and I do recommend it. But one thing I noticed was the way it looks at your asset allocation, at least in my case, was just flat out wrong. They had numbers that were wrong. They weren't seeing that some funds, for example, I own a Schwab TIPS fund, and it wasn't seeing it as a TIPS fund. It was seeing it as just a nominal bond fund, just wrong. So I really like Empower. In fact, I will show you Empower. This is a demo version, and I was actually looking at the asset allocation tools. But if you connect all your accounts, you can see all your investment holdings, you can see your investment fees, and you can drill into your asset allocation. And at least in my experience, Empower gets it right. And you can drill down and look at the different kinds of investments. Again, this is just a demo account, but I really like Empower. You could also use my free investment tracking spreadsheet. This is, again, a demo version of it. I will leave a link below the video both to Empower and this spreadsheet. They're both free. There are paid tools that I like as well. I like Kubera. I like Stockrover. So you could use paid tools if you get if there's an advantage for you for doing that. But again, plenty of free tools. But that's challenge number 1. If you're not using something to track your investments, pick something and start tracking your investments. Now, for our video, I'm going to actually open up my version of the investment tracking spreadsheet, and that's what we're going to use. And I'm going to actually go to the whiteboard to do this. So we're going to start with asset allocation. We'll just put stocks here, bonds here, and then I'm going to talk about cash in a minute, so I'll go ahead and put that there. At a high level, if you look at all of our cash, bond stocks, here's our allocation overall. It's 77.61% stocks, and bonds, and for the moment, I'm including in this the cash, 22.39%. Now, our actual goal is 75-25, so we're not too far off. I probably will do some rebalancing, but not right away, and it has to do with some cash that we're going to spend. So it'll make more sense for us to rebalance probably at the end of end of January. But this isn't too far off, and I'm perfectly fine with this. Now, my actual portfolio, about 20% of it is in individual stocks. We'll talk about that in a minute. But what I do is, from an asset allocation perspective, I ignore the stocks at first, and I say, okay, what do I want my asset allocation to be for all of our funds, that other 80%? And the goal is that when I add back in the individual stocks, I get an allocation close to this, which, as you can see, we have. The reason I kind of go through that is I'm going to walk through the allocations I have for our funds, and they exclude our stocks. I'll treat the stocks separate. So where are we with our funds, our ETFs and mutual funds allocation? And we'll start with U.S. stocks, very broad. We have 44, we'll call it 40, I'm just going to round a bit. We'll call it 43%, it's just a tad more. Now, the interesting thing about that number, 43%, is that most of our U.S. stocks, again, if we exclude individual stocks, come from total U.S. market. So, for example, we own VTI, a Vanguard ETF. that fund includes exposure to small cap and mid cap. But in my spreadsheet, I don't break it down like that. For that fund, I just have it as U.S. stocks. If you use Empower, for example, it will break it down. You'll get even finer detail. For us, at least in this purpose of this video, I think looking at it this way is good enough. We do also have some small cap, a small cap fund, and that comes out to, we'll call it 10%. It's a tad more, but we'll call it 10%. I don't have any REITs. I think REITs are a great asset class. I've owned it most of our investing lives. I did away with them just for simplicity, keeping in mind that there are REITs in the U.S. stocks that we have. So we do have REIT exposure, but I don't have a separate REIT fund, mainly for simplicity. Who knows? I might change that at some point, but no reason to do it right now. And then for international stocks, we have about 18 and a half. My goal is 20, but we're a little shy of that, 18 and a half. And we don't have any separate allocation to emerging markets. But again, the funds that we use for international exposure include emerging markets. So again, if we were going to use Empower or a tool like that, we could go into the details and look at it in a finer perspective. But I think again for this is probably good enough. And that's it. That's my stock allocation. I'll show you the specific funds in just a minute, but that's it. Pretty simple. I mean, in fact, if we just cross out the REITs, it looks really simple. It looks, we've got two funds for stocks, or for U.S. stocks here. But other than that, it's pretty straightforward. Now, let's talk about bonds. Bonds, again, normally pretty straightforward. We basically have, I'll call it bonds. And by that, I mean nominal bonds and then tips, right? That's basically it. And we have about 8.5% in bonds, and it's about just over 10% in tips. So that does need some adjusting. And the reason it's gotten a little off kilter is because, believe it or not, I currently have 9% in cash, which is utterly ridiculous. The reason so what would normally be in cash for us? Normally it would be an emergency fund. That's it. And I don't know what that would be. Call it 1%, 2%, something like that. And that's it. That's all we would have. So we have more in cash because we're spending it next year. We had planned to spend it this year and on some home stuff, kitchen remodel kind of stuff. It didn't happen. It's not going to happen. We're going to spend it somewhere else. But this number will go down in 2024. Probably back to, just an emergency fund. But right now, we have a little more in cash than we normally do. Okay, so that's at a high level. I'm going to walk through the specific actual investments that we own, but let's get to another challenge. And I'll give you two challenges. We've got 5 total. Remember, the first one was track your investments. The second one is, can you get your overall expense ratio across all your investments to 10 basis points or fewer? If my mom's watching, I'm pretty sure that's the correct grammar, not less. I think it's 10 basis points or fewer, but you get the idea. Now remember, 100 basis points is 1%. So 10 basis points is just 1/10 of 1%. Again, if you're using index funds, shouldn't be that difficult. I can tell you our overall expense ratio, and actually this spreadsheet that I use will track this for you. It's about 7 basis points. So we're doing well. I don't see that changing, and so far looking good. So that's challenge number 2. Challenge number 3. This one's where things might get a little more difficult. Set for your goal in 2024, apart from possibly rebalancing, or apart from you need to actually spend the money, which certainly could be true if you're in retirement and you're pulling money out of your portfolio to spend. Putting those two things aside, set as a goal that you will not sell anything in 2024. I can tell you in 2023, I sold absolutely nothing other than cash investments. And by that, I just mean some CDs at one point and T-bills. And those got sold because I needed to spend the money. But in terms of my investments, we didn't sell a single thing. And that's our goal for 2024. And I'm challenging you to do the same thing. And that's true no matter what happens in the world. Doesn't matter how ugly things get, what interest rates do. Can you try to commit to that challenge, not to sell anything in 2024? Again, If you've got to spend the money, that's one thing. If you're rebalancing, I get it. But to sell just because you're scared or you're nervous or you think you've figured out where interest rates are going to go, yeah, that's the challenge. So that's number 3. All right, now let's look at the specific investments that we hold. And I think I'll just go back to our whiteboard here. I'll just carve out some space here. We'll, I guess you know what I'll do. Let's actually go to a new page. And what I'm going to do is we'll do stocks over here, which is going to be the most of it. And then we'll do bonds over here. And this will include cash. So what do I own? I don't think it's any different than last year. That's supposed to spell cash. Doesn't look like cash. Anyway, so we'll start with the funds on stocks, then we'll go to the individual funds. So we own VTI. VTI is a Vanguard ETF that tracks the U.S. stock market. Very broad-based fund. We own VXUS, which is another Vanguard fund that tracks basically all of international. So between these two funds, by the way, I mean, those would be 2 of the 3 funds in a 3-fund portfolio. You can have all of the stock exposure you need right there. I wish ours was that simple. It's not. I'm going to jump over here. We own a fund called TIP, TIP Fund. It's an iShares TIPS bond ETF. So we own that for part of our TIPS exposure. We own, just going through it, as another TIPS fund, we own SCHP. Now, you might say, well, Rob, that's interesting. Why do you own these 2 funds? Why not just own one fund? And let's take a break here for a second. Let's jump over to Morningstar for a moment, because this may be an area where Rob needs to do better. So if we look at TIP, it's an iShares TIPS bond fund. What I want to look at is the duration. I think it's intermediate term. It is 6.5 years. You could think of duration as how long on average it's going to take for the bonds in that fund to mature. It's not technically correct. That would be effective maturity, but it's close enough. It's effectively a weighted average time for you to get all your money back, kind of is what that means. But in any event, and then the other one, as I said, is SCHP. It's also a TIPS fund. And if we go to portfolio, we can see it's basically the exact same fund. So that would be, let's go back to the whiteboard. This would be a great place for me to simplify our portfolio and combine, either this one into that one or that one into this one, right? And that gets me to the 4th challenge, and one that I can perhaps satisfy right here. And that is, get rid of an investment. Figure out at least one way to simplify your portfolio. Like in my case, I've got 2 TIPS funds. Do I need? They're basically the same thing. Why do I have them both? Sell one and use the proceeds to buy the other. So now that would, you say, well, you're selling. That would kind of violate the rule. Yeah, maybe. That's an exception to the don't sell rule, though. You're just taking it and putting it into the exact same kind of investment to simplify your portfolio. So that's challenge number 4. Figure out a way. It could be just one thing that simplifies your portfolio. All right, let's get back to the whiteboard, and let me get back to my list of funds. What else do I own? Well, you're going to love this one. I own another TIPS fund, and it's FIPDX, which is Fidelity TIPS Fund. So see, here we go. I probably need to simplify. What else do we own? We own SCHD, which is a Schwab dividend fund. We own this in our Roth accounts. And I don't, as longtime listeners know, I don't much care about the dividend here. The reason I invested in it is because of its tilt towards value. And so we own that. Let's see what else we own. All right, in terms of funds, okay, now we own 3 other stock mutual funds. And let me go right down the list. VFWAX, that's an all-world, it's an international fund. Now here, you might say, well, wait a minute, Rob, isn't this a place for consolidation? The answer is probably not. Why? Because this one is in a taxable account and it has embedded gains. So if I were to sell this, I would incur significant taxes. So I'm not going to do that. And you say, okay, Rob, but what about this one? And yes, this is in a retirement account, but I'm probably not going to sell that to buy this one. Why? Because I prefer VXUS. And the reason is, let me just pull it up. Let me pull it up on Morningstar and I'll show it to you. So here's Vanguard's FTSE All World excluding US. That's what this all means. Vanguard FTSE All World excluding US Index Admiral shares. If you go to the portfolio, you'll see, it's a broad-based fund. If we look at the weights, though, you'll notice it has no small cap. VXUS does. If we go to VXUS and go to the portfolio and go to the weights, it has. Now, it doesn't have a lot, 4%. You might say, Rob, that's not a big deal, and you'd be absolutely right. It's not a big deal. But I still prefer some exposure to small cap, and you may say, well, Rob, if that's the case, why did you buy that other fund in the first place? Because I owned VXUS. I bought it lump sum investment in 2018. And if you recall, later in the year, 2018, bad market, went down. I took some tax loss harvesting, and I put it into this other fund as a way to avoid the wash sale rule. And then the stock market and everything took off, and now there's a lot of gains in it. So I'm okay with that. But that's why I'm not consolidating those two. And VS, let's see, I own VS MAX, which is small cap. By the way, same issue there, a lot of embedded gains. I don't know that that would be my number one small cap fund of choice. I think it's fine, but I'm not selling it anytime soon. And I own VTSAX, which is identical to VTI. It's just a mutual fund version. Again, a lot of taxable gains in that fund, so I will not be selling. And then the last fund, before we get to the individual stocks that we own that I didn't mention, is over here, B&D. So all of this would be TIPS. B&D would be what they would call nominal bonds, or they're not protected by inflation. And there you go. Now, I will say, in terms of cash, we do have T-bills. So right now, all of our cash, or almost all of it, is in a handful of T-bills. So there you go. Those are the funds. You've seen my asset allocation. The only thing left would be to talk about the individual stocks. They have not changed from a year ago. We own Apple, which is ticker AAPL. That's by far the largest. We own B shares of Berkshire Hathaway. We own some Bank of America. We own some Wells Fargo, and we own some Deere. Now, you might look at this and say, boy, that seems familiar, Rob. Doesn't Berkshire own all of this stuff? Well, more or less, although I can say that I did buy Apple before Warren Buffett did. So I got that going for me. But yes, there is some overlap. And of course, with Apple particularly, but with the rest as well, there's overlap with VTI. There's overlap with VTSAX. And should that overlap concern us? Well, that gets us back to using a tool that will show you your asset allocation. So you can look at all of the details. You can sort of do what Morningstar would call an X-ray, where you look through the fund into what it actually owns. And something like Empower will do that for you. Again, there are other tools. In fact, you can do a paid subscription to Morningstar and use their portfolio tracker if you want. So that's my portfolio. I guess I'd have to go back and watch the video from a year ago. If there's anything that's changed, it's not significant, I don't believe. And that's the portfolio. Now, I mentioned a challenge. So we've talked about figure out a way to track your investments. Try to get your expense ratio to 10 bips, 10 basis points or lower. Commit to not selling anything in 2024 again, except for rebalancing, or you're going to consolidate two funds. That'd be good, or you need to spend the money. Eliminate one investment if you can, or some other way to simplify your investments. And then number 5 is this: don't buy anything new. That's not to say don't invest. You already have funds, presumably ETFs, mutual funds, and your 401k, your IRA. Maybe you'll be adding to them this year. Hopefully you will. If you haven't already retired, that's great. But commit to not buying anything new. Just what you have is probably fine. And if it's not, figure out what you need right now, next week. Make those purchases, make those investments, and then say, okay, I've got what I need. I'm not going to add any new investments. If I'm going to add money to my portfolio, I hope you do, I'm going to pick one of the investments I already have. I'll probably pick it based on my asset allocation and what maybe there's one asset class that's a little low, so I'm going to put some money into VTI, or maybe it's VXUS because my international is a bit low. Whatever it might be, try to stick with what you've got and not add any new investments. Those are my 5 challenges for 2024. And so I thought I'd share them with you. So there you go, my portfolio. Again, I don't pretend that my portfolio is the best portfolio or what you should do. It's interesting. I will end with this one thought. I have my individual stock portfolio has beat the S&P 500. I think every year, almost every year, and certainly aggregate, it has beat the S&P 500 since 2014. And but I've gotten lucky, and it's beaten the S&P 500 for one reason and one reason only: Apple. And it's the largest part of that part of my portfolio, and it's just done extremely well. If Apple ever gets to a point where it's not doing well, I will absolutely underperform the S&P 500 without a doubt. So I guess sometimes it's better to be lucky than good. We'll see how it plays out in the future. But in terms of the vast majority of our portfolio, 80% of it, low-cost index funds, I think it's the best way to go. There you have it. If you have any questions, leave them in the comments below. I will leave links to the tools that I've talked about below the video. And there you have it. If you have any questions, let me know. And until next time, remember, the best thing money can buy is financial freedom.